Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine. Thanks for tuning in. Right here on AM 760 KFMB. Hey, Al, I want to go through a couple of these questions I got from Advisor Insight.
Oh, good. Okay.
And they sent me an email and with 1,000 questions on it. But I thought, you know what? These are decent questions, and so let's just kind of go through them because I would imagine some of our listeners have the same questions.
I would think so.
All right. Number one here. So this is from someone from zip code 98125. And the title is, can I deduct IRA contributions from a 3-hour weekly part-time job?
From a 3-hour weekly part-time job? Sure.
So
The only limitation there, in the IRA, you can put $5,500. Unless you're over 50, you can do $6,500. You just have to have enough salary to cover that or earned income.
So he goes, the summary is, I am self-employed without a retirement plan. However, I have a part-time job, 3 hours per week, that has a 401a retirement plan.
Oh, okay. There's more to it.
My savings contributed by my employer are about $144. Is it true that I would not be able to deduct IRA contributions from this part-time job simply because I don't have a retirement plan?
So now, when you are in a retirement plan, even if you have $1 of benefit from your employer, then you're considered to be part of an employer-sponsored retirement plan. And so therefore, you fall under the income limitation rules. And so the answer is, well, first of all, you can always do a IRA. You may or may not be able to deduct it. You may be able to do a Roth contribution. You can't deduct that. That may be even more advantageous. But if you're below certain income thresholds, I don't have that table in front of me. It's around, I don't know, $70,000, $80,000 single, something like that, where if you make more than that, you cannot deduct a regular IRA, but you certainly can still make one.
Next one. What is the maximum tax-deductible contribution I can make to an IRA if I contributed to a 401k from January to June 2015? I file a joint return. My husband made no contributions.
Oh, very good. Well, all right. So
again, it's the $5,500, and if you're over 50, you can go 65. Both of them can make those deductible contributions. But since, again, she's got the 401k plan, it would fall under those income limitations.
Yes, it would. Now, married, it's a little bit higher numbers in terms of the income limitation rules. And there's something else, too, and that is even if your joint income is too high for you to deduct an IRA, your husband, who's not working, may be able to deduct an IRA because those rules, that starts phasing out at about $183,000 or so. So there's more likelihood that the spouse can actually
even though the spouse doesn't have income, because there's the non-working spouse
so you can,
contributions that you can make.
Right. You can use the working spouse's earned income to qualify for your own IRA.
Right. So that's a huge mistake that a lot of people make, is that, all right, well, here, I'm not working, so I can't contribute to a retirement account. Well, that's true if you're single, but if you're married and one spouse is still working, you can still contribute to a Roth. You can still contribute to an IRA.
Sure, you can.
Because of the spousal, non-working spouse election there.
Right.
All right. So there we go. 2 for 2. I understand that when filing jointly, over $32,000 in Social Security is taxable. What if you're on Medicare? All right. Let's see. I understand that when filing jointly, over $32,000 in Social Security is taxable. What if you're on Medicare? Well, I would imagine if you're automatically enrolled in Medicare as soon as you claim your Social Security benefit.
Well, yeah, as long as you're 65.
Correct. So,
yes. So presumably she's over 65. And so being on Medicare doesn't do anything in terms of this calculation. What does matter is you look at your provisional income, which is half of your Social Security plus all your other income, plus a few other things like tax-free interest, for example. And if that's over $32,000 as a married couple, then you have to start paying, or is it 20? What's the first number? 25,000, Joe? If it's over $25,000, then you got to start
25
paying,
to 32, 32 to 44.
Yeah, 25 to 32, then you have to pay tax on up to 50% of your Social Security. And if you're above the 32,000, it could be up to 85% of your Social Security is taxable.
So with Medicare, I mean, those are two different things. I mean, unless they're talking about, do I still pay a Medicare tax? You'd pay a Medicare tax if you're still working. So you could still collect your Social Security, be on Medicare, and then still pay a Medicare tax,
right? That's
out of
true.
your payroll.
And that would only if you're full retirement age, because if you're less than full retirement age, you start getting your Social Security benefits taken away.
Right, phased out in a sense where, if you make more than $15,700, something like that, then every $2 earned, they take $1 back. Once you reach the year of your full retirement age, then that's up to about $45,000 of income.
It's a bigger limitation.
So it's like $44,800 off of memory. But then once you reach your full retirement age, and then people get that confused. It's like, well, once I reach the year of my full retirement age. Well, yeah, because Social Security works in months, right? So let's say if your birthday's in June, right? Well, in January of that year, you're not full retirement age yet. So you can make, in this example, January to June, up to about $45,000. If you make more than that in that time period, every $3 earned, they'll take $1 back if you are claiming your Social Security prior to your full retirement age. But once you are at full retirement age, then you can claim your Social Security benefit and still make as much as you want and not necessarily be subject to those phase-outs.
Wouldn't you say in most cases, if you're working, you wouldn't want to take your Social Security benefits? I mean,
yes.
even past full retirement age.
Yeah, well, I think it depends. I've ran into people that don't necessarily have a lot of income, and they're behind, and so they're thinking, hey, well, maybe I take the Social Security income on top of my smaller income once I'm at full retirement age to get more income.
Sure.
And then I'll save it.
Yes.
It's like, okay, well, if you do that, then you have to get 8% or more, because once you turn full retirement age, they give you an 8% credit on that benefit. So I think with everything in life, it all really depends. But I would say in most cases, if I'm full retirement age and I'm still working, I think it makes more sense to delay to get the 8% delayed retirement credit.
I do too, because as you say, so full retirement age for folks right now is age 66. So if you wait all the way to age 70, that's 4 years. That's a 32% higher benefit. So that's a third again as much, right? Roughly. So let's say your benefit's going to be $30,000, or let's say $20,000 of benefit. A third again as much is another $7,000, let's say. So $27,000 is your benefit at 70 per year instead of 20. And that's can be a pretty big difference. And the more money you make, the higher the more this can make a big difference.
You know, in life, we make choices, and with choices come consequences. So if you decide to take your Social Security at 62, 66, or 70, there are consequences, good or bad. Like, for instance, you could either take the stairs or ride the elevator. You could eat an apple or a candy bar. You could drink a Coke or maybe a glass of water. Go to the doctor or ignore the symptoms. Planning for retirement is no different. You have a choice. You can create a plan or you can hope for the best. In either way, there will be consequences. But having no plan is almost destined to have a very, very bad ending. If you've saved for retirement, good for you, but now what? What about Social Security? What about reducing your taxes, guarding against inflation, generating income? And how will you withdraw your money from your retirement accounts? All right, we got to take another break. Show's called Your Money, Your Wealth. Don't go anywhere. Right here on AM 760 KFMB.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joey Anderson. I'm a certified financial planner with Big Al Clopine. He's a CPA. Thanks for tuning in. Reading a couple of email questions from you that I got from Advisor Insights. It's from Investopedia. You ever go to Investopedia?
I have.
So she's like, here's just a few of the latest questions with your areas of expertise, Joseph.
Okay, good.
So I'm supposed to log in and answer them.
Right.
But I'm breaking the rules.
You're doing it on the air, and you're going to send them the podcast.
Yes, I'm going to.
It's like, here you go.
Or I'll just have like Mike or Megan listen to it and then type it out.
Yeah, you could do that, sure.
Okay. So let's see here. Here's another one for you. What is the optimal long-term investment vehicle when someone has maxed out all tax-advantaged accounts, including 401ks, HSAs, FSAs? Am I missing anything that doesn't include income limits?
Okay. Well, I didn't hear mention of Roth IRA.
But he or she is concerned about income limits. So maybe...
Well, still, though, income limits for a single person, they start phasing out at, what 117,000, I think, this year.
Yep.
And married,
it's 184,000.
Right? So that's, if from an earlier segment, we talked about the people that make that much money. They're in the top 15%, so not everyone makes that much.
True. So here's something that she or he could do. So if you're looking for deductions, so they're looking for, all right, well, here, 401ks or 529s, but you don't, super funded 529 plans, they said, well, you don't get a tax deduction for 529 plans. It grows tax deferred.
Yes.
And then you get tax-free income coming out of it if it's paid for higher education costs. HSAs, so health savings accounts, so you get a tax deduction there, grows tax deferred, and then you can pull it out tax-free if you have a highly deductible health plan. FSAs is similar, flex spending accounts or cafeteria plan, Section 125. Yes. That's a pre-tax contribution that grows tax deferred, but then it's a use it or lose it.
That is correct. Yeah. In other words, by December, you got to use those benefits, otherwise you forfeit it.
So then, am I missing anything? Well, let's see. Anyone can contribute to an IRA. No matter what your income is, that will grow tax deferred for you.
Well, anyone
unless you're under 70 and a half and you have earned income.
Yes, right.
Almost.
Couple qualifiers. I was thinking compliance nightmare.
Just do it. Anyone can do it. But you have to have income and, yeah. So, like, I guess the point is, I'm saving into a 401k plan. I can still contribute to an IRA if I'm under 70 and a half and have earned income.
Yes, you can.
But I can't take the deduction.
Right, and correct, if your income is too high. If you don't have another IRA, you can do a backdoor Roth contribution. So you contribute to that IRA, you don't take a tax deduction, and then you convert that same IRA. And because you didn't get a tax deduction, it's not taxable as a conversion. It's kind of a workaround, I guess, on Roth contributions for those that don't qualify. But there's that huge caveat. First of all, you do have to be under 70 and a half. That's number one. You have to have earned income. But also, if you have another IRA, you got to aggregate that balance, and this doesn't work very well. If you have 401ks, 403bs, it's fine. But if you have no other IRAs, this is a great strategy for you if you got high income. Yep, and that's on the docket to go away. It is, yeah. What the hell's a docket anyway? I say that a lot. It drives me nuts. I'd have to look it up on Wikipedia. It's on the docket right here. I assume it's just like a sheet of paper. Yeah, but I don't know the official meaning of it. I suppose it sounds better then. It's right here on this official sheet of paper. It's saying a lot in a short word. Yes, it's a very important document. Yeah. Okay. Now this is an interesting question. This proves that there's some misinformation. Okay. There's a title here in that. Let me finish before you answer. Right. So the title is this: Can I still contribute to my Roth IRA if my spouse earns over the retirement cap? Maybe that's a misspelled word. Requirement cap? I don't even know what a retirement or a requirement cap is. Maybe income requirement. Maybe, yeah. So can I still contribute to my Roth IRA if my spouse earns over the income, let's just call it income requirement cap? Well, if you file a joint return, well, I don't know if she's looking or well, that's the spouse. So I don't know what spouse is looking at what.
Because they might say, all right, well, here, you make more than $132,000, let's say for 2016. Well, that's for the single, but for married, it's $194,000. So that's
Sure.
the income requirement cap for a married couple if you file a joint return.
Yes.
If the spouse makes more than $194,000, you cannot contribute to the Roth. Let me go on.
Okay.
My spouse makes over the amount allowed to contribute to a Roth IRA. However, I do not. Is it possible for me to contribute to my Roth IRA even though we are married and his income is above the requirement cap? Again,
Okay.
that's, well, what requirement cap is you're referring
I
to?
think you're right. It's the income cap.
But I mean, is he or she looking at the single or the married? You know what I mean?
Well, it's the
Because I've seen this before. It's like, okay, well, let's say my husband or my wife, in my case, let's say my wife makes $150,000 a year.
Sure.
I don't make anything. So then I look, all right, well, if I'm for a single person, it's $131,000. Well, maybe they might be thinking because only one person has income,
So I
they're
can
looking
use
at the
single
wrong table.
tables. Well, you do use the married tables, so that's the first thing. But if your husband, assuming he's looking at the or wife, we don't know if it's male or female. If the working spouse, if their income is over the married income limitation cap, we'll call it that, then you have the same problem. You can't contribute either because it's a joint thing.
Okay. I understand compound interest as it relates to a basic savings account. If you get 5% interest on $1,000 each year, it'll be worth $1,050 at the end of the year, as $50 interest was added. Over time, it will keep compounding. How about if you invest $1,000 in an S&P 500 index fund, will go up and down, which is not exactly the same as compounding. It may go up way more than 5%, but can that really be considered compound interest?
That's an interesting question. How would you answer that one?
Well, it's not compound. The rate of return is compounding.
Yeah.
With the S&P 500, I mean, interest is based on a note, and a note is a loan, and so that could be a bond, it could be a CD.
Mm-hmm.
So,
but the way that they compute what the rate of return is a compounded rate. So, in other words, 5 years ago, yes, you invested in the S&P 500, and let's say it earned 10%. Okay, well, that's a compounded number, as if it was like a flat 10%.
Right. Yeah, but it's an average.
It's an average.
It's an average rate of return.
Some years it was 30, some years it was -4, whatever, right? But the compounded rate is, the average rate, I should say, is 10%, and that would be the same as putting your money in a bank and earning 10%. You end up in the same spot.
You got it. Should I take my RMD from my stocks that have dropped the most in my IRA? All right, I have to take RMDs from my retirement IRAs invested in stock funds soon. So should I take my RMD from the stocks that have dropped the most, Alan?
Yes.
No, you do not take your RMD, the ones that drop the most, or you could.
Well,
maybe that might make sense because this is what you could do. All right.
Okay.
Is that, let's say you have an IRA and you have stocks inside the IRA, and some of the stocks have gone down in value. Should you take the RMD from those stocks? If you were going to sell them and go to cash, no. But if you say, all right, well, here, give me whatever stock ticker it is, and you just take the distribution from the stock, you don't have to put it in cash. You can just do a journal and put that stock in now a brokerage account, right?
Sure.
Huh? You see where I'm coming with this?
I like your thinking.
And then as soon as when the stocks accumulate in value, guess what? Then you sell it at a capital gains rate.
Yeah, so in other words, you got the stock out of the IRA when it was low, and then it hopefully, I mean, this is the hope, right, that it goes back up, appreciates, and now when you sell it, you get a capital gain rate, which is a lot better than the rate from an IRA, which is ordinary income.
Right, and so you got to, but if it comes from a 401k plan, you have to cash it. I mean, it's cash. It's going to come to you as cash.
That's right.
But if it's in an IRA, you can journal shares, which I think a lot of people don't know.
Very few people know.
You can say, here, I'm just going to journal the shares of the required distribution. So we got to take a break, but when I get back, let's dive in a little bit more into this topic, because I think there's some cool tax planning that can be done when stocks go down, where you don't necessarily have to sell the stocks to put them in a lot better tax-favored environment. So don't go anywhere. Go to our website at purefinancial.com to get more information about us. We'll be back in a second. Show's called Your Money, Your Wealth, right here on AM 760 KFMB.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He's a CPA. Thanks for tuning in. Happy Saturday, or happy any day of the week, because you're listening to the podcast.
Wow. Yes. Could be any day of the year.
Any day of the year. Go to the iTunes. The iTunes.
The iTunes.
Go to the iTunes and subscribe.
One of my favorite pieces of artwork that one of my sons did. This is Robbie. 5th grade. No, kindergarten. 5 years old is what I meant to say. 5 years old. And so
Junior in college?
Yeah. He drew a picture of the Clopine family. And it's like there's these 2 little legs and a big butt and then a skinny little torso and a head. And there was 4 of them because there's 4 of us in the family. And it said on it, the Clopine, single. Loved it. Absolutely loved it. That's the Clopine.
So go to the internet and what the hell is it called again? iTunes. Go to iTunes. Your Money or Wealth. Just type in the search box and subscribe. So we were talking about this question that came in, and if you're just joining us, I'm part of a couple of different groups that I answer questions online to help individuals out with their overall retirement, right?
Sure.
And so I got a bunch of them, and I was like, well, I'm not going to type all this stuff out. I'm just going to, say it on the air.
Right.
Okay?
Like it.
And one of the questions was this, is that should I take my required minimum distribution from the stocks that have dropped the most in my IRA? Now, there's a couple of ways that you can interpret this and what they're actually asking, right? And first of all, an RMD is a required minimum distribution that you have to pull out of a retirement account if it's in an IRA, if you're over 70 and a half. If you are still working, however, and if you're an active participant in your 401k plan that don't own more than 5% of the overall company, you do not have to take a required distribution until you retire. So that's since I was shortcutting some of the stuff earlier.
You were. That's right.
So you can look at it as this individual says, you know what, these stocks, they're awful. I'm dumping them. So I have to take the distribution anyway. So which one should I sell, right? So let's look at the ones that have gone down in value and sell those. And then when I sell them, I'm going to buy better investments, quote unquote.
Right.
And I'm going to look at which ones have performed better. And then that is the one I'm going to purchase because we think that we're going to extrapolate those returns over time, which the opposite is probably going to be true, where you don't want to sell the individual investments that are down in value. You want to sell them that are up. So that's one way to look at it. So the answer to that situation would be no, but we're going deeper.
Yeah.
We're getting a little bit smarter than this.
Let me just add that this works a little bit better if it's an asset class. If it's a stock doesn't always come back, right? A stock may go down and stay down.
Correct.
Whereas an asset class like the S&P 500 made up of 500 stocks, well, if that's down, that will come back, right? You can, as long as capitalism works.
It may come back.
I should say may. It will very likely
high
come
probability.
Back. But if a stock goes down, there's no particular guarantee that company will ever recover, and it's probably not the right investment. We wouldn't even recommend those as the investments, but assuming that we make the assumption that she's got good stocks and that they're going to go down but come back up. So we'll make that assumption.
Or let's just say it's a stock mutual fund.
Okay.
How about that?
Okay.
Here's what you do. So in the mindset of most individual investors, they sell when assets are down and then they buy asset classes that are up. Here's what I would do with your required minimum distribution. Now, it has to be in an individual retirement account to do this. All right. So if it's in a 401k plan that you have to take your RMD or your requirement, it's not going to work because the company's just going to send out the requirement to you, probably in direct deposit it in your checking account. So they're going to sell that security, sell it. So it's sold, it's out of the market, and then you're going to get cash. If it's in an IRA, you can journal shares. And so what does that mean? Journal shares means, all right, well, here I have XYZ stock or XYZ mutual fund, and my required distribution is $10,000. So what I do is I say, okay, well, here, I want $10,000 of XYZ mutual fund journaled out to my brokerage account. All right? So you're journaling that out. You pay tax on it. It's outside of the retirement account, so it satisfies the required distribution of the $10,000 or whatever it can be. But now you didn't sell it. It still has this. Now it's in my brokerage account. Now what do? Okay, well, potentially then now I took the RMD. It's still down in value, right, from where I bought it, even though it doesn't have cost basis, though, right? Because once you journal it in your brokerage account, that's going to be the basis. But you had a preconceived notion of basis in the retirement account because you bought it for $10 a share. Now it's worth $5 a share.
You are right about that. So in other words, what it's worth when you journal it out is your new cost basis.
Right. So
and the brokerage account statements, the companies, they don't always get that right. So be careful of that one.
So, but because I know in my head, hey, I bought this at $10 a share. Now it's worth $5 a share. I'm going to journal it into my brokerage account. Now it's at $5 a share. But then when it recovers, okay, when that asset class recovers and goes up in value, guess what? Now you don't have to pay capital gains tax on it. You pay capital gains tax on it, not ordinary income tax.
Correct.
Another strategy, when markets are down, Roth IRA conversions is a phenomenal strategy. It's the same concept. Hey, these account balances are down, right? So now is a really good time to take those and convert those into a Roth IRA. And then when that asset class recovers, guess what? All of that income is going to come to you tax-free. So you just take a little bit extra layer. And again, this is what we're talking about all day, is that when you got a certified financial planner and a CPA looking at the tax consequence and how all this stuff works versus just looking at your, whatever the asset allocation is, well, combine tax to the equation, you're going to have a better outcome.
It is true, Joe. And I was actually just going to say the same thing. So you went the same place that I was thinking, which was now your RMD, your required minimum distribution. You have to distribute that out. And as you say, Joe, when it's an IRA, it can be in cash or it can be in kind. It can be shares. And that's now if it's in a 401k, and you could potentially do the same strategy, you just have to sell that position in the 401k, take the cash, and then buy it.
Buy it right back.
Buy it right back. So yeah, there's a little bit of, you may be out of the market for a few days, right? And then
it could be a few weeks.
It could,
right?
It could, yeah. And actually from a 401k, you're right. It could be a few weeks, and you got some trading costs. So you'd rather journal it entry out.
But to piggyback off that, there would be no, let's say if you did that, you sold it onto the 401k plan, it's at a loss in the 401k plan, but it doesn't have any basis. So there is no wash sale rule there.
That's correct.
Right.
Yeah.
So even though you have your own calculated basis in your head of, hey, I bought this for $10 a share, now it's worth $3 a share, you could sell it, right, and then buy it back the next day, potentially, if it came from a 401k plan.
That's true.
But forget about that. I mean, if anyone's ever done a 401k rollover, depending on the company, depending on HR, depending on how accurate your paperwork is, and if you just filled out the right form of direct rollover versus rollover, and if they're withholding taxes, not withholding taxes, setting up the overall accounts, sometimes that takes a long time. If it's at an insurance company, forget about it. They'll hold on to that money for months, it seems like.
They do. And so, Joe, your point, though, is the best time to do a Roth conversion is actually when an asset class or a market is down, because you get that money into the Roth, you get more shares in a Roth, if you will, at a lower cost basis, and then when they recover, all that recovery is tax-free. And so few people think about these things when they're trying to design a retirement income stream. And they make so many mistakes. I mean, I just can tell you, I've just seen so many people doing the wrong things, and they get really excited about maybe their investments, but they got the wrong investments in the wrong tax pools, and they're paying a lot more taxes than they really need to pay. And as a CPA for over 30 years, I am kind of amazed how people do make these mistakes, and they don't really get the message until it's too late. And so there's a better way to do it, but learn from others, and the secret is to make sure you don't avoid the same things that they have done. Don't learn it the hard way. You can save more in taxes than you think, but you must use a forward-looking, tax-efficient strategy.
All right, we got to take a break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joey Anderson, Big Al Clopine. Thanks for tuning in. Right here on AM 760 KFMB or podcast.
The podcast, yes.
Podcast.
Yeah,
go to the iTunes.
You're promoting those a lot today.
Go to the iTunes. Have you ever seen that movie with Vince Vaughn?
I've seen a few of them.
The Intern.
Where
it was interning at Google.
I did see a movie called The Intern, but it was a different one.
I thought it was called The Intern.
That was Robert De Niro in that one. Anne Hathaway. That's a recent one.
Oh, wow. That must have been just a wonderful date night.
I liked it, actually.
Really?
Yeah, I did. Yeah.
The net or the E-net. The E-net, I think he kept on calling the internet.
Oh.
Anyway, you got a quiz for me, don't you, bud?
Yeah. Do you know about Roth IRAs?
I do know
You
a
heard
lot
of 'em?
about Roth IRAs.
Yeah. I got 10 questions. They're actually pretty easy. I actually rewrote 2 of them because they were misleading. So here we go. Your upfront contributions to a Roth IRA are tax deductible. True or false?
False.
That's correct.
They
yeah.
are not tax deductible. They grow 100% tax free, though.
Yeah. So that's what you give up. You don't get a tax deduction today, but all future growth, income, principal is tax free.
But I think that's all right.
I do too.
Because if you think about what we have done over the last several years, is that we put money into a retirement account and get the tax deduction today. Okay? So let's say you put in, max it out, $24,000. All right, let me check your math real quick. $24,000, Al, and I'm in the 25% tax bracket. What's my tax savings?
Tax savings is $6,000.
Okay, so save six grand. All right?
Plus state.
Okay, $7,500.
Okay.
You fine with that math?
Yeah.
Give or take, hypothetically?
Yeah.
So I saved $7,500. I got $24,000 in. Okay?
Okay.
Then that $24,000 grows to $100 grand. Then I pull the $100,000 out. What do I pay in tax?
Well, you're
25%
still 25%
tax
bracket. Yeah. So plus state. So let's say you get about 65 grand out of that 100,000.
Right? So 65 minus 100 is what?
35.
So I get $7,500 deduction, but I got to pay it back. I got to pay $35,000 back.
Yeah. Yeah. In other words, the tax benefit grew just like the account.
Correct.
Yes. And so you end up paying a lot more tax.
Yes.
That's correct.
So if I forego the $7,500 tax deduction and that $24,000 grows to $100,000, then I pull the money out. What do I pay in tax?
Yeah. You pay nothing.
Zero. There is no better rate than zero.
Yeah. I agree with that.
So I think we have to relook at some things here.
We do. Now, of course, it does depend on a whole lot of factors, your tax bracket and what it's going to be in retirement versus what it is right now, and that's a whole other discussion. But here's question 2. These are all true false, by the way. You can withdraw your contributions from a Roth tax-free right away, but there are restrictions on withdrawing your earnings.
Correct. This is a really cool thing about the Roth, which I discourage anyone from doing this. But
you're going to say it anyway.
But if you do, I should lie to the public.
Can't do it.
If you do contribute to a Roth IRA, let's say you put $5,500 into the Roth IRA, you have access to that $5,500 the next day, no matter what your age. So if you're 35 years old, you put money into the Roth IRA, the next day you need the money, you can always pull that money out. I encourage this too. This is big. Let's say that you have not made a Roth IRA contribution for 2015 yet. Since we are now in what is it? April 2nd.
April 2nd. Mm-hmm.
April 2nd, 2016. For those of you that are listening to the podcast.
Yes. Wow. They're going to be listening to it in 2038. Wonder when this one was.
Wonder when this one was there.
What's that Roth IRA, honey?
Is that you still got time? You got, I don't know, 15, 16 days. I think the deadline's at 18th
Yeah,
today?
it's, believe it or not, April 18th is tax date this year.
So start a Roth IRA for 2015. You still have time. Put a couple of dollars in it. If you don't have the full $5,500, put as much as you possibly can, or at least start the account with $100, right? Then that starts your 5-year clock. Your 5-year clock starts January 1, 2015. So I highly encourage you, if anyone, I don't care how old you are, if you're 65, 70 years old and you're still working, you have earned income, please do so, because at some point you might want to utilize the Roth, right? And then that will satisfy the 5-year clock starting 2015. So you're already a year, right? Now you only have to wait 4 more years if you've never started a Roth before.
Here you go. There is no age limit for contributing to a Roth as long as you or your spouse have earned income to contribute. There's no age limit.
There is no age limit on a Roth.
That's correct.
As long as you have earned income, yes.
Yes. Yeah, that's true. Okay. The maximum you can contribute to a traditional IRA is different than a Roth IRA.
Wrong.
It's the same number.
It's $5,500, $65,000 if you're over 50.
That's correct.
And then $13,000 if you're married, and only one spouse needs earned income to make contributions to a traditional IRA or a Roth IRA.
Yeah.
You do have to be under 70 and a half to do an IRA contribution, though.
Yes, you do. And I think that's one of the most missed tax techniques there is you're working, your spouse is retired, you're both over 50, you do a Roth contribution for $6,500, your spouse can also do one. And that means you both can have Roth IRAs and start earning tax-free income. All right, here's one. Anyone and I mean anyone, can contribute money to a Roth IRA, even Donald Trump.
Yeah. Anyone can contribute to an IRA, even Donald Trump?
Yeah, that's what it says.
Well,
That answer's false.
why wouldn't the Donald be able to do the, what, is he over 70 and a half?
No, anyone can contribute money to a Roth IRA.
Oh, Roth IRA. I thought you said IRA.
Oh, sorry.
Well, no, he could do probably an indirect.
He could do backdoor.
Backdoor.
Maybe.
He could maybe.
In other words, there's income limitations, and so once you're married and your income's above $184,000, you start getting phased out on making those contributions. All right, you never have to withdraw funds from a Roth IRA in which you contribute. You're not listening, are you?
Yes, I am. I'm thinking now.
You never have to withdraw funds from a Roth IRA to which you contribute.
Well, no, if you're the owner of the account, no.
Yeah, that's correct.
If you're the
That's true.
beneficial owner, yes.
Well, you're 2 questions ahead of me. Hold on.
Well, you were giving me grief
You were just sitting there
because I was
looking
not.
at me like, what are we doing?
No. All right. So before, when I was going through some of this, I was a compliant nightmare. Now I'm trying to give the very details
Okay.
of the strategies that
Wow.
we are discussing.
Okay, fair enough. Anyway, that is true. You never have to withdraw funds from a Roth IRA to which you contribute. All right, let me skip ahead because I know that's where you wanted to go. Let's see. Your heirs never have to take money out of a Roth IRA that they inherited.
Yes, they do. They have to take a required distribution based on their life expectancy.
They sure do, so that's false.
So, for instance, here's the thing: is that couple of different things when it comes to inherited IRAs or 401ks for that matter. If you're married, a few things to look at is that you can basically combine the marriage. So, if I'm married, I could take my wife's and move it into mine. She could take mine and put it into hers, if that makes sense. Now, if I keep it in my wife's, I wouldn't not have to take a required distribution until she would have turned age 70 and a half if she predeceased, right? But if it goes to a non-spouse beneficiary, all non-spouse beneficiaries have to take a required distribution based on their life expectancy. So even if it's a 5-year-old, that 5-year-old has a life expectancy of age 86, so they would have to take out 1/80th or 181.
Yeah, 181.
Let's say their life expectancy is age 85, and they're 5 years old, so they need to take 1/80th out.
Okay, that's easier to say.
Yes.
All right, well,
1/80th one.
I guess the bottom line is if you're not contributing money to a Roth IRA or converting money to a Roth IRA, you got to be looking at this because tax rates, they may be going up here in the future. You look at our national debt, you look at Social Security, you look at Medicare. You got to get some money to Roth IRA so you can start having some of your income tax free to stay out of the higher tax brackets.
Thanks so much for listening. For Big Al Clopine, I'm Joe Anderson. We'll be back again next week right here on AM 760 KFMB.